Warren Buffett is one of the world's most successful investors. If you are stepping into the world of investing, Warren Buffett's wisdom can help you make wise financial decisions and grow rich. In this video, we will reveal Warren Buffett's time-tested investment rules for beginners. His 3 rules for investing are the foundation for anyone looking to kickstart their investment journey. Stay tuned until the end to discover what it takes to grow your wealth and make every investment a success.
I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So I don't worry too much about the things I don't understand. If you understand some of these businesses that are coming along, you may have an entirely different field of expertise.
Let's start with the first rule. Warren Buffett's first rule: invest in what you understand. Investing can be a daunting task, especially for beginners who are planning to enter the world of financial markets. Warren Buffett is one of the most successful investors of all time, and he emphasizes the importance of a fundamental principle: invest in what you understand. This simple guideline carries significant implications for individuals who are planning to start investing. Basically, this rule urges investors to stick to areas of expertise. Before delving into the details, let's explore why Buffett places such significance on this fundamental principle. In the realm of investing, knowledge is power. The more you understand about a company, industry, or financial instrument, the better equipped you are to make informed decisions. Buffett's investment philosophy revolves around the concept of a circle of competence. He advises investors to draw a circle representing the boundaries of their understanding and to only invest in businesses that fall within that circle. This approach encourages a focused and disciplined investment strategy. For instance, if you have a background in technology and understand the dynamics of the sector, it makes sense to invest in tech companies. On the other hand, industries or financial instruments that are beyond your understanding increase the risk of making uninformed decisions. Psychology plays a significant role in investment decisions. When individuals invest in something they don't fully understand, fear and uncertainty can cloud their judgment. This often leads to emotional reactions to market fluctuations, potentially resulting in poor decision-making. Buffett's rule seeks to mitigate these psychological challenges by promoting a rational and informed approach. By investing in what you understand, you're better positioned to weather market volatility and make decisions based on a solid understanding of the underlying factors influencing your investments. To implement Buffett's rule effectively, thorough research is important. This involves studying financial statements, understanding the competitive landscape, and staying informed about the industry trends. For those with limited financial knowledge, taking the time to learn the basics of investing is a crucial step toward expanding their circle of competence. Moreover, the rule encourages a mindset of continuous learning. As industries evolve and markets change, staying updated on relevant information ensures that your circle of competence remains dynamic and adaptable. To illustrate the practical application of this rule, let's consider a real-life scenario. Suppose an investor with a background in healthcare decides to invest in pharmaceutical companies. Their expertise allows them to assess drug pipelines, regulatory landscapes, and competitive advantages within the industry. Contrast this with an investor who, lacking knowledge in the tech sector, decides to invest in a high-profile software company. Without a deep understanding of the industry dynamics, this investor might be swayed by market hype or short-term fluctuations, leading to suboptimal decisions. Buffett's success is often attributed to his adherence to this principle. His investments in companies like Coca-Cola and Gillette reflected his understanding of consumer behavior and brand strength. By applying this rule, Buffett built a portfolio of companies he comprehended, contributing to his remarkable success over the years. While Buffett's first rule provides a solid foundation for investors, it's not without its challenges and criticisms. Some argue that it may limit diversification, potentially exposing investors to concentration risk within their circle of competence. Others suggest that it's overly simplistic and may lead to missed opportunities in rapidly evolving industries. However, Buffett's response to these concerns lies in the idea that a larger circle of competence can be developed over time through continuous learning. By expanding one's understanding of different industries and sectors, investors can strike a balance between focused expertise and prudent diversification. Warren Buffett's second rule: focus on long-term value. In the world of investing, where markets can be volatile and sentiment-driven, Warren Buffett's second rule provides a compass for investors seeking stability and success. This rule advises investors to focus on long-term value rather than being swayed by short-term market fluctuations. Let's dissect this principle, examining its nuances and the rationale behind Buffett's emphasis on a patient and value-oriented approach. Warren Buffett's second rule is based on distinguishing between short-term market movements and the long-term intrinsic value of an investment. While markets may experience fluctuations based on daily news, economic reports, or geopolitical events, the underlying value of a solid company tends to appreciate over the long term. Buffett's investment philosophy supports the idea that market prices may not always reflect the true value of a company. In the short term, stocks can be subject to emotional buying or selling, creating opportunities for investors with a long-term perspective to capitalize on market inefficiencies. At the core of Buffett's second rule is the concept of intrinsic value, the true worth of an investment based on its fundamentals. While market prices may deviate from intrinsic value in the short term, Buffett believes that over time, the two tend to converge. Investors who focus on understanding the intrinsic value of a company can make more informed decisions, irrespective of short-term market noise.
You can rearrange your business empire, which you own through that little portfolio that you have. You can rearrange that, at a moment's notice with practically no cost. It's a huge advantage, which people turn into a disadvantage. There is nothing about the price action of the stock that tells you whether you should keep owning. What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning.
Buffett advocates for patient capital, emphasizing the compounding effect over time. By holding on to quality investments for the long term, investors can benefit from the power of compounding, where returns generate additional returns. This long-term approach aligns with Buffett's own investment style, as evidenced by his commitment to holding investments like Coca-Cola and American Express for extended periods. The second rule also addresses the psychological aspects of investing. Short-term market fluctuations often trigger emotional responses, leading to impulsive decisions. Investors who succumb to the temptation of chasing short-term gains or panic selling during market downturns may undermine their long-term investment goals. Buffett's strategy involves staying focused on the underlying value of investments, regardless of short-term market movements. This disciplined approach requires a certain level of detachment from market noise and a commitment to the fundamental principles of value investing. While the second rule encourages a long-term perspective, it doesn't imply a disregard for risk management. In fact, by focusing on the long-term value of an investment, investors can better navigate short-term volatility and reduce the impact of market downturns. This approach aligns with the notion that quality investments tend to recover and thrive over the extended horizon. To illustrate the practical application of this rule, consider Buffett's investment in the Coca-Cola Company. Despite short-term market fluctuations, Buffett maintained a steadfast belief in the long-term value of the company's brand and business model. This commitment allowed him to ride out short-term market challenges and benefit from the significant appreciation of Coca-Cola's stock over the years. Warren Buffett's third rule: diversify your investments. Warren Buffett's third rule advocates for a strategy that has stood the test of time. Diversify your investments. This rule underscores the significance of spreading investment capital across different assets to mitigate risk and enhance the potential for long-term returns. Let's uncover the layers of this principle, examining the rationale behind Buffett's emphasis on diversification and its practical implications for investors. Diversification involves spreading investments across a variety of assets, such as stocks, bonds, and real estate, as well as within different sectors and industries. The fundamental idea is to avoid putting all your proverbial eggs in one basket. By holding a diversified portfolio, investors aim to reduce the impact of poor-performing assets on the overall investment portfolio. The primary objective of diversification is risk mitigation. Different assets and sectors may respond differently to economic conditions, market trends, or unforeseen events. A diversified portfolio, therefore, is better positioned to weather market volatility and economic uncertainties. While some investments may experience declines, others may remain stable or even appreciate, contributing to the overall resilience of the portfolio. Buffett's approach to diversification involves considering the correlation between different asset classes. Assets that are negatively correlated tend to move in opposite directions, providing a natural hedge against volatility. For example, during economic downturns, defensive stocks or bonds may show resilience while more cyclical stocks face challenges. However, it's essential to note that excessive diversification can lead to dilution of potential returns. Buffett emphasizes that investors should focus on a manageable number of investments within their circle of competence to ensure a balance between risk mitigation and capital growth. Beyond diversifying across asset classes, Buffett also encourages diversification within industries. Economic cycles can affect industries differently, and having exposure to a variety of sectors can enhance a portfolio's stability. This approach aligns with Buffett's emphasis on understanding the businesses in which one invests, ensuring a more informed and strategic diversification. While diversification is crucial, Buffett warns against over-concentration in too many assets or sectors. Over-concentration can lead to a lack of focus and dilution of expertise. It's essential to strike a balance, ensuring that the number of investments allows for effective risk management while still allowing investors to stay well-informed about each holding. In today's interconnected global economy, diversification extends beyond geographic boundaries. Buffett recognizes the impact of globalization on investment portfolios and suggests that investors consider international exposure. This global perspective allows for broader diversification and exposure to different economic cycles and growth opportunities. Buffett's investment decisions, such as his stake in Berkshire Hathaway, exemplify the principles of diversification. Over the years, Berkshire Hathaway has evolved from a textile company to a conglomerate with diverse holdings, including insurance, utilities, and consumer goods. This strategic diversification has contributed to the stability and growth of the company's portfolio. Thanks for tuning in to discover Warren Buffett's invaluable investment rules for beginners. If you found these insights helpful, don't forget to hit the like button, subscribe for more financial wisdom, and ring the notification bell so you never miss out on future wealth-building tips. Share your thoughts in the comments below. Let's build a community of savvy investors. Until next time, happy investing.